The market is crashing. Red numbers everywhere. News channels screaming panic. Friends telling you to sell everything. And suddenly, your investments look smaller than yesterday. Your confidence starts shaking. Your mind whispers one dangerous thought. Maybe I should exit before it gets worse. But here is the quiet truth. Market crashes are not the enemy of investors. They are the birthplace of wealth. Every major fortune in the stock market was built during periods of fear, not excitement, not hype. Fear. When prices fall, opportunities rise, but only for people who stay calm, only for people who understand the rules of the game. Because in a crash, emotions destroy wealth, but discipline creates it. So the real question is not, is the market crashing? The real question is, do you know how to invest during a crash? If you do, a falling market can become the greatest wealth-building opportunity of your life. Let's understand how calm investors win when everyone else is panicking. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility.
Step 1. Understand what a market crash really means. A crash is simply a rapid fall in stock prices, usually 20% or more. But businesses do not disappear overnight. The economy slows, fear spreads, investors sell aggressively, prices fall faster than value. That gap creates opportunity. For example, imagine a strong company trading at 1,000 rupees. During panic, it may fall to 700 rupees. The business did not lose 30% value in 1 week, but the price did. Calm investors understand this difference. Fearful investors do not. Step 2. Protect your foundation first. Before investing during a crash, check your financial base. Do you have an emergency fund? At least 6 months of expenses. If your monthly cost is 30,000 rupees, you should have about 1.8 lakhs saved in a liquid fund or savings account. This protects you from selling investments in panic. Next, check your debt. High-interest loans above 12%, credit cards, personal loans. Clear them before aggressive investing, because debt grows even when markets fall.
Step 3. Continue your SIP. This is where most investors fail. They stop their SIP during crashes, exactly when they should continue. SIP means Systematic Investment Plan. You invest a fixed amount regularly, let's say 10,000 rupees every month. When markets fall, that same 10,000 rupees buys more units. More units today mean larger gains tomorrow. This is called rupee cost averaging. Over time, your average purchase price falls. Crashes actually improve long-term SIP returns. Disciplined investors understand this. Emotional investors cancel the SIP and miss the recovery. Step 4. Maintain smart asset allocation. Never put everything into equities. Balance matters. For many long-term investors, a simple structure works well. 60% equity funds, 20% debt funds or bonds, 10% gold, 10% cash or liquid funds. Example, if you have 10 lakh rupees invested, 6 lakh rupees in equity mutual funds, 2 lakh rupees in debt instruments, 1 lakh rupees in gold ETFs, 1 lakh rupees in liquid funds. During crashes, equity falls, but gold or debt may stay stable. This balance protects your portfolio.
Step 5. Rebalance strategically. This is a powerful but ignored strategy.
During a crash, your equity allocation may drop. Example, your 10 lakh portfolio becomes 8 lakh rupees. Equity portion falls to 4.5 lakh rupees. Now your allocation is no longer 60%. It becomes lower. Rebalancing means restoring the original structure. You move money from safer assets back into equities. This forces you to buy low, automatically, without emotional decisions. Step 6. Understand risk cycles. Markets move in cycles: boom, correction, crash, recovery, expansion. These cycles repeat for decades. For example, during the global financial crisis of 2008, markets crashed heavily. But over the next decade, indices multiplied several times. Crashes are temporary. Economic growth is long-term. Patient investors benefit from this cycle.
Step 7. Be aware of taxes. Taxes affect your final returns. In India, equity held for more than 1 year falls under long-term capital gains, currently taxed around 10% above limits. Short-term gains are taxed higher, around 15%. Frequent buying and selling during panic can increase tax burden. Long-term holding reduces friction. Tax efficiency supports compounding. Step 8. Avoid common crash mistakes. First mistake, selling in panic. Second mistake, stopping SIPs. Third mistake, trying to perfectly time the bottom. No one consistently predicts market bottoms, not even experts. Fourth mistake, investing money needed within 2 years. Markets need time to recover. Short timelines create pressure.
Step 9. Scale investments gradually. During crashes, do not deploy everything at once. Invest in stages. Example, if you have 2 lakh rupees ready, invest 50,000 rupees now. Another 50,000 rupees after deeper correction. Continue through SIP. This staggered strategy reduces timing risk and increases psychological comfort. Step 10. Think like a long-term owner, not a short-term trader. Businesses grow over years. Innovation continues. Economies expand. India's long-term growth story remains strong. Stock markets reflect that growth, but patience is required. Wealth rarely comes from excitement. It comes from discipline, consistency, and emotional control. Crashes reveal who the real investors are. Not the loudest voices, not the fastest traders. The calm ones, the disciplined ones, the ones who follow a plan even when fear surrounds them. Years from now, your future self will look back at market crashes, not with regret, but with gratitude. Because while others panicked, you stayed calm and quietly built wealth.